Hello there. Right, so Oak Bloke here, and this is just me. Haven't got a specific sing topic in mind, but just thinking about my. This is my 25 for 25, and let's perhaps zoom in on that a little bit so you can see it perhaps a bit clearer. So just sort of thinking about these and progress year to date. So this was the original article back on more or less the 1st of January, and the 25 ideas. We'll just spend a little bit of time talking through what's worked, what's not worked, where my head's at with these, and where do I think they'll go from here. So just quickly, the top one, well, I mean, when I say the top one, the first one in the list was NubDug, the NB distressed debt. Interesting about that is I actually called time on that it's about 6 weeks ago now, I think, and it's interesting that I seem to have got the good of that because I saw that it had gone up in price, saw that it had jumped. So I thought, well, it's made about 40%, including capital returns. So why not get out now while the going's good? I'm still probably leaving some money on the table, but that's okay because it's made a good return. But actually, I must say, here I am looking at it again. You can see how much it's fallen back. I might am I allowed to sort of change my mind about calling time? I don't know. But yeah, certainly, it's interesting to see it. It's dropped back and looking quite attractive. What I've done is, so these were the sort of how they all stood back on 1st January. As you can see, I had Pershing Square, Contrarian, Macango, a total sucker, SDCL, which is SEIT. And over here, well, this was the forecast return, and what I then did was apply kind of and these were just my how should we say that my estimates of risk. So what's the risk of performance? What's the risk that it won't perform in time? So speed risk, and then just a risk of it all going horribly wrong. So the loss risk. Are they cash generative? And then based upon that being the in an ideal world return, and then this being the sort of nuanced on the basis of risk. So something that's a very high return like Macango, but is medium high. I kind of came out with a 70% risked return was my estimate. So let's see how I did with some of these. So Macango, pretty good actually. This is up 48%, but if we went back in time a little way, Macango was up. It was actually a double bagger. It's just like NubDug. It's dropped back quite a bit. It's dropped back by about 5p. So it's now at about 15, 16. It hit 20. So yeah, it's doing well, and this I've written an article today on UUUU, and this kind of similarly, really, this is a recycling of rare earth magnets, and that's a bit of a political hot potato. So pretty much everything I've written today, well, not everything, but some of the aspects I've written about today with energy fuels, same applies to Macango, in that the US, and not just the US, the UK, Germany, everyone needs rare earths, and if the Chinese are restricting the export of those, then there needs to be a plan B option. So Macango is one, Energy Fuels is another. One of them gets the rare earth magnets from existing rare earth magnets by recycling them and doing so efficiently, whereas Energy Fuels goes into heavy mineral sands, and inside that is monazite, which normally gets chucked in the bin, or handled as a radioactive substance. So it kind of gets handled as dangerous waste. Whereas Energy Fuels said, well, hey, we know all about radiation because we deal in uranium. And of course, the thing that makes monazite radioactive is typically either uranium or thorium. So they have actually worked out how to take the monazite and extract out the rare earths and extract out the uranium from that monazite. So that's actually done pretty well actually. So Pershing Square. Pershing Square's up a little bit. So Pershing Square's just 4%, but again, that's been up a lot higher and it's dropped back. It's obviously quite let's say a victim or damaged by the Liberation Day tariffs and affected by that. So yeah, to see it only up 4% is not altogether a surprise. You can see here I've got 3 that are kind of almost nearly double baggers, so I'm pretty pleased with that. It'd be nice to have more than 3, but that would be greedy, wouldn't it? So you'll also notice that dividends is actually number 4 in the list. So the dividends that have come through are yeah, I mean quite a bit of this. I mean, I'll just quickly share this bit here. The dividends, the NUBDUG dividends was a big one. GCF, SEIT, APAX, OCN, and so on. So yeah, quite good dividends. So that's kind of brought in 680, and obviously I'm counting capital returns in and amongst that number. So that's sort of dividends and capital returns. So that's the sort of 4th largest performer. Kavango I've written about recently, and Kavango I'm very excited about, and I think it does come with risk. Of course it does. This caving spirals article here, but they're heading towards cash generation. If they can get there, then there's lots and lots of runway for this to grow and grow and grow. And obviously this is sort of a slightly imaginative, I think is probably the word, depiction of the spirals. I think the actual spirals will be probably not quite as grandiose as what I'm showing you there, but the idea is not far away from what I'm showing you here, that they're going to have trucks driving out of a hole in the ground, and by doing so they'll be able to excavate lots of material very cost effectively. And if the material that they're excavating is rich in gold, then with current gold prices, I mean, it's a slam dunk pretty much. So we'll see on that one. The next one on the list is the Gore Street Energy Storage Fund. So see, a lot of people said about this that it was going to not do well. There's a lot of negativity towards it. I think the Harmony deal, where Harmony ended up in competitive bids and pretty much sold for NAV. I mean, this is still well below its NAV. I mean, this is the interesting thing about GSF, is that actually when you look at it, it's still got a long way to go, in the sense that just GSF, if we have a look at that, it's still on a 36% discount to NAV. And the other thing to say is, I mean, you can buy it at 63p, but that dividend yield, so the next dividend is the big one, and that's 4p, and obviously 4p on 60p or 64p, that's a pretty chunky dividend. I mean, that in itself is what, 6%, and then the other 3 dividends during the year added up to 3 pence. So this is, this I mean, these numbers are not often that accurate, but it's not far off 11. I wouldn't say it was 11.9. That's usual thing, inaccurate, but yeah, it's about 11% dividend, and of that 7% of that is coming up in the next, it's about 2 months time, that the big dividend is going to happen, if assuming it does happen. Obviously nothing is certain, but certainly with the tax credits being received and the sale of those tax credits received, it's looking good because obviously that money could be used for the dividend. So we'll see. Livermore, again, this is one that's gone up a lot this year and come back down. So there's a little bit of a theme here where at different points along the road that certain ideas have done much better. Strange. Let's try liver. Oh, okay. Doesn't exist apparently, but yeah, it does. Livermore has has returned some interesting results so far. So we'll let's move to the next idea. Serica. So Serica's kind of recovered a little way. This 62%. This is because it's I weighted this six times. So it's actually a 10.6% return. But what I've done is I've kind of considered it at a 6 times weighting, and this one's the same. This is down 11%. Or sorry, 11%. Or 11.3%. So that, or actually you can see it here, 11.23%. So it's a six times weighting because I put 1,000 on all of these except these two where I put 6. I went in heavy on Serica, and that's sort of not been a massively, but it's certainly improved, and the Triton. Then there was a terrible storm that messed up the Triton FPSO, and I mean these things happen. I don't regret I don't regret the choice. I don't think it was a bad choice. I mean, could I have foreseen that there'd be a terrible storm that would have damaged the FPSO? I mean, give me a break. So yeah, it's just one of those things that it's in the short term it suffered some disruption, but the long-term story is still very positive. These guys, they've finalized the sale of Wilson Sons, so there's a big cash return coming, a tender offer. I haven't made up my mind whether I'm going to take it or not. I mean, we don't know the terms of it for a start, so we'll see. I'll do whatever's advantageous to generate the best possible outcome to win the race if I can. So I'll let you know in a future article. But even the investment portfolio is strong. I've had a nice strong dividend out of Ocean Wilson's, and people sort of say, oh well, it's it delivered a poor performance, etc. But again, just because things have done something in the past, it doesn't mean that there's that adage, isn't there? Past performance doesn't guarantee the future returns, or there's that sort of standard disclaimer. Well, that standard disclaimer can work the other way, where just because it's not performed in the past doesn't mean it can't perform in the future. And I think when you actually take the different component parts of Ocean Wilson's, the bit that has worked incredibly well is the private equity part of it, and specifically the new private equity. So this is private equity investment and kind of private credit investment into US and European, whereas going back sort of 11 years and more and older, they were sort of doing private equity into places like the Philippines and Peru, and developing countries where those haven't been terribly successful and aren't to this day. Whereas the newer, post 2014 investments have kind of returned about 20% a year. And I mean, one of the question marks is, well, what are they going to do with the Wilson Sons money? Well, if they bang the whole lot into private equity in US and Europe, I actually feel very positive about that, because they've proven they can deliver great returns. And I sort of agree with people that say, oh well, like some of the stuff they're invested in is like just index funds, and stuff that you could just invest in yourself. There's, you're paying charges on charges on charges, and like, what's the point? And I agree with that. So that's why I think what I'm looking for, in order not to call time on Ocean Wilson's, is a strategy that sort of gives you something that's genuinely different and better. And I mean, logically, why would you not do private equity? Because that's something you can't just go to the stock market and buy. Well, other than via Ocean Wilson's, of course, because they can access those funds, and you, the private investor, or the whoever you are, can't directly, in all likelihood. So yeah, look, from my point of view, I'm 9.6 return. I'm happy with that. It's going to grow. I think it's going to be a higher return by the end of the year. JPEL, again, it's done well. It's on a big discount, so happy enough with that. The Bailey Gifford small Japanese fund, I mean, that number doesn't really reflect the performance. Some of that is down to the fact that the yen's even just sort of gone stronger. The Big Mac index I keep referring to as kind of part of that it's but I don't think that's going to carry on. I mean, the holdings themselves are doing extremely well. Obviously, we don't get to see like every single one of them, and what are they buying, what are they selling, but we do know what the 10 are each month. And when I look at the top 10 and look at their quarterly results, look at how they're progressing, pretty happy with them all. They're all pretty reasonably, they're good companies. And actually, when I sort of say, well, let's just line them up against like a UK equivalent company, there's one that was like similar to Judges Scientific, and I was like, well, hang on, it's like Judges Scientific, but it's like half the price. So there's lots and lots of really positive read acrosses as well, and just even things like ramen shops where you kind of can think like, and again, I'm just using my own practical common sense here, that like, when there's like 10 a penny pizza places, and one of the other fun runners had what was it called, something or other food, sort of like a pizza, some sort of food. Let me see if I can find it. Actually, it's going to bug me. Let's have a look. It's what am I thinking of? Tortilla Mexican Grill. And like, not being funny, but there's lots and lots of Mexican places. Like there is, like you've got all the chains of Mexican places and stuff like that. Like being able to buy really good ramen, I don't think that's so easy. I mean, there are places, I know places dotted around in certain big cities, but yeah, I think Japanese food's got a far larger runway than Mexican food, because Mexican food's quite generic, really. It's and Mexican food is one of those foods that can be westernized to your heart's content. And to be fair, I mean, it's not like proper Mexican food. I mean, if you've been to Mexico, you'll know what I'm talking about. That it's not. It's really not. And actually, a lot of Mexican food isn't. Well, again, I'm going to be controversial here. There is a lot of bad Mexican food in Mexico. I mean, there's some great food. Don't get me wrong. There is some great food, but there's a lot of bad restaurants. I've traveled extensively in Mexico, and I speak with experience there. Maybe that's changed. I mean, I haven't been there in a number of years, but certainly, yeah. Anyway, I'm very happy to be in the smaller Japanese fund, and really like the holdings that are in there. So we've talked about this one. I tapped out at 5.5%, but then there was a big chunk of capital returns that's in there, so that I think it was 40% when I tapped out. So I think about half of that dividend is actually nub-dug. Maybe I should just sort of move the numbers so that it's clearer. But anyway, so next one, Mercy. I mean, I've written about this. So now we're into the losses. So we've kind of, everything's been a gain until this point. Mercia to be on a loss when they've announced £250,000, no, sorry, £250 million. get my magnitudes right. They've managed in the first quarter of 2025 to grow their VCT EIS fund business by £250 million, so 250 million. So they're now at about 2 billion funds under management, and they're aiming to have 3. They've also kind of said, that they're in line with expectations, and also they've made some announcements on some of their because they also, as well as funds under management, they've also got a portfolio of businesses that they've backed, so they've got sort of equity in those businesses. So yeah, I think what's going to happen with this one is they're going to release their actual results, and everyone's going to be, wow, look how great those results are. And this is just my opinion. None of this is advice. None of this is, it's just my opinion. But it's also my reading of the numbers and reading of just analysing it out. And you could go and look at my article. In fact, let's just quickly do that, because yeah, if we just go into here and into sorry, Mercia. Sorry, my brain went. So I've, there's two articles here that Merck gives a smirk and lots to like. I mean, the Merck gives a smirk was the fact that they announced two funding rounds that basically meant a 3 million. They didn't say it was a 3 million uplift. It was coded. It was coded language. But what they said was they had a funding round for their Warwick Automotive. This is so. This is if you've got £45,000, you could have a gold. I think it's gold plated. I don't think it's even solid gold for 45,000, but it'll play beautiful music apparently. 37 design parameters for the perfect audio experience in a car. So they've got a first contract with an automotive. They reckon, and I mean, this is their claim. This isn't, this is just me regurgitating their claim that their music, their stereos generate or consume 90% less energy. So therefore, for a battery electric vehicle, it's an extra 20 miles of range. But yeah, anyway, within all of this, they said that the last valuation was that they had 35.8% of the company, and that on that valuation, which implies that it was worth 33.3 million. This thing here where they say, they had follow-on and fully diluted is 31.7. So that basically, when you do the maths, it works out that so 5.2 million came from other funds, which obviously Merck also earned money on. So the 5.2 million of funds from outside of Merck is profitable for Merck anyway. But it basically works out that because they invested 1 million, so they own 12.7 million. That works out at a 40 million valuation for the company overall. So essentially, and then the same with this one. The valuation went from 26 to 34. So actually, when you sort of work through the maths of that, they've made 2.4 on the one and 0.6 on the other. So they've made a 3 million fair value gain. So it was a 20% gain and a 32% gain on their holdings. Okay, and the Warwick was the third largest, and the other one was, I think it's down here. This one here. So it's about, they're both top 10 anyway. So that's sort of a plus 2.4% to the share price, or should be. But what happened? Well, the share price dropped on the news. So go figure. Yeah, and I mean, they've got a history of achieving uplifts when they exit. I'm just on the. Oh, cheers, Anne. Sorry. Yeah. Let's Right, yes. So anyway, that's that one. So that's that one, and next one's Ovation. So down 5.5, but overall um, has been going up. It sort of hit a bit of a low around, I think, February. Is buying back its debt, is paying off its debt, is has announced that the rates for rentals are going up. On larger aircraft, they're going up a lot. On smaller aircraft, not so much. But again, when you work through the numbers, the great thing with Ovation is that let's just go back here. We can quickly look at that one as well. Ovation. Yeah, so last one was this one here. Is it plain to see? So yeah, with this, yeah, just sort of work through that they've taken out an 85 financing facilities. That's obviously debt. That's going to be to buy further aircraft. They reckon that will enhance cash flow. They've also they've also been able to get that at a lower rate. That they reckon that will increase cash flow by 400,000 a month. So when I looked at sort of the return on aircraft, I sort of came out with a sort of a sort of a net gain was that if you sort of took it on this was on a 20-year life, and and sort of without so divide by 20-year life, and sort of it was sort of very, very marginal. But then when you sort of said, well, hang on a minute, the depreciation is not 20 years, it's 25, and there is a residual, then the economics of this change dramatically. So that's kind of everything that's going on before they took out this facility. So anyway, it was me trying to work out, well, this up to 400. Well, how would they be able to say up to 400,000 a month of cash flow? Anyway, I sort of worked through the numbers, and also sort of to started to kind of just work out, so up to 13 million revenue on 80, minus the finance costs, minus depreciation. It kind of worked out at about, in my calculations, 8.5-ish million a year. So that would double profits, which was great. All happy days. And again, do this, I'll be like, well, surely everyone's really happy about this great news, this positive news, and it's like, no, share price is down. So today, 138. Today, I think it's above that. I think it's back up about £1.50-ish, almost 150. Yeah, there we go. 149. So yeah, it's sort of, people have sort of woken up to it a little bit, but yeah, there's lots and lots of stuff going on, and I'm pretty sure that the other thing that I worked through on this was I just sort of started looking at there was also some other good news around things like the arrears collection. So they sort of said, that they'd been able to collect. They collected 6.4 million, and I looked at the accounts and I thought, well, there's only 4.2 million outstanding that's overdue. So therefore, there's 6.4 that they reckon they've collected. Assuming it's all of that, then there's still sort of 2.2 million. And if some of it isn't this, then it's more than 2.2 million. But it was sort of almost things that had been written off before that were being unwritten off. They were being reversed back on as income, which is great news. Great news as well. And also just things like this, that there's passenger numbers are at a high, that there's very positive positive news around that. the passenger kilometers are increasing 7.1%, surpassing historical highs. That because of a shortage of commercial aircraft, that there's very supportive pricing. And I think what I did, and I'm sort of working through this article, what I did was I also sort of tried to work out what different aircraft rented for, and then to work out, well, if you had a narrow body, then the uplift would be this. I can't see that I've written it in this article, but perhaps it was in a different article. But anyway, we've spent quite a bit of time talking about aviation. I'm sort of refamiliarizing myself with it a little bit. But yeah, next one. I mean, I've written about this one this week, and this is down 7.4. But again, it's been down a lot more and is sort of back up, I think. So if we just go back to this and sorry, my brain full of tickers. It was THS. Sorry, brains. This might be a good time for THS. Oh no, sorry, that's an old article. We go back. THS. Yeah, this was the one I did in March. It's these two here. so the red one is before the results came out. The blue one, blue ink on, or blue paint on the hand, is the post. I mean, I'll just quickly talk through both. This was the forecast article, so painful thistle. So you know, it's that I sort of covered that there was sort of various challenges, and that you know, there was the civil war, there was the cybersecurity, there was the poor level of grade in Q1 because of disruption. And then sort of Q2 was that you know, that there was sort of a drop of the material because of bad weather, we were told, but actually the PGMs had bounced back up. So the PGM, which is obviously platinum group metals, had sort of leapt back up in, well, leapt is probably not the right, leapt up in volume, and that was more that even though they were mining less volume, the quality of that volume had increased. And that was sort of on the back of that they'd been prioritizing chrome rich feed, and they reverted that with obviously chrome prices being substantially down. And I sort of did some maths to work through, and I found that the cost of sales about 208 a ton for the chrome, which kind of on 235, I mean, you say, oh, well, that's quite good because that gives you $27 a ton. But well, no, because once you sort of include all your overheads, you're pretty much making no money at all. That's a fool's errand. So the fact that they've, you know, moved to processing more PGM rich feeds, the right thing to be doing in that circumstance. So as I say, I mean, it's actually not that terrible, and it's obviously the decision to switch the feed is the thing that's probably saved it. And I hadn't even worked that out until just now, but that's sometimes by doing these videos you kind of get these insights, I suppose, on stuff. But anyway, and I sort of said, look, they've told us that it's going to be like 2 cents to 3 cents, and yeah, so that's the sort of results that I forecast there. That you know, it didn't look that bad, was the quick version of the events. So anyway, yeah, so kind of comparing it as well to Sylvania, to Jubilee, to just the price of palladium and platinum. You know, that blue one there is Tharissa. So it's you know, again, obviously, yes, it's down, but that's kind of almost a universal wide. But all three of them are now sort of bouncing back up, and as I speak, Platinum's now nearly to 1100. So there's been a real bounce in certainly in platinum, and we'll have to see. So and it was interesting because the PGM report from Johnson Matthey was pretty negative, I thought, towards the forward prospects. They said, oh, well, battery vehicles are going to, cause all sorts of issues for PGM demand, and palladium's going to be in surplus and things like this. And anyway, I looked at the same numbers. I also then looked at automotive demand, and just I didn't really see the same evidence, or at least I suppose the evidence that Johnson Matthey was looking at was 2024 evidence, whereas the 2025 evidence is that well no, actually, automotive demand, and actually the automotive demand for hybrid vehicles and plug-in hybrid vehicles is far, far stronger than perhaps people are sort of, assuming that everyone's going to switch to battery electric vehicles. And well, no, it looks like people are switching to hybrids, and hybrids are the ones that are growing faster. So these rhodium, palladium, platinum, from memory, I think palladium is used with diesel catalytic converters and platinum is used with petrol, although that might not be a hard and fast rule. Don't necessarily quote me on that. And then rhodium is used in both. But hybrids, because they run because with hybrids you don't run the engine as much, therefore the engines run cooler, therefore you need to load more PGMs in your catalytic converter for it to screen out the bad stuff, So that's yeah. So I kind of feel that the report is that there's going to be this decline in demand. I don't think there will be. I think that we'll actually be surprised that and they themselves admit, if battery electric vehicles underperform and hybrids gain traction, the if is, well, no, it's not an if, it's happening. Or at least, as I speak, and so was it 24th of May, so far it's happening, and there's no change to that in sight. The decline could be smaller than anticipated. Well, yeah, I think that's pretty nailed on as far as I can see. And I sort of show it here for the EU, I think this is. So hybrids 35, plug-in hybrids 7.6. So you've got, what was it, 42, 43, and then battery electric is 15, and obviously diesel, petrol is then another 38-ish%. So kind of 85% of nearly 85% of the market, don't know what these are, is presumably using catalytic converters. And you can see here in America, battery electric is going down, and the hybrids are going up, and the plug-in hybrids are sort of not sure what to do with themselves, but mild hybrids here are going up. So that's the they call them F hybrids. Not sure what the F stands for. So yeah, anyway, World Platinum Council sort of also agrees that platinum and palladium are going to both equally be in shortage. So these guys don't agree with Johnson Matthey either, that there is no shortage. I also saw evidence like, well, Toyota, this is one of the most popular cars in America, and Toyota have said, we're not going to sell an pure ICE version, internal combustion engine version. It's going all hybrid and plug-in hybrid. That's the only versions you can buy from, I think it's from September this year. Is going to be sort of 100% hybrid or plug-in hybrid. So lots of, oh, that seems to be in that article twice. Anyway, so yeah, again, let's sort of start to draw this to a close. But Tharissa, I think, is going to do well. I called time on this one, so this now is sort of, I guess we could say, locked in, something of that nature. So that one has called time, as has this one. So these are sort of both sort of locked in gains and losses. But yeah, I just didn't like the update, didn't like, and it's interesting because I wrote my article and then I sort of saw that there was other articles out there that other people had said, oh, yes, it's a wonderful, wonderful update and very positive. And so we'll see. It'd be interesting to see who's right. I'm pretty adamant that I'm right, but I can see why people are saying that the leak detection is going to be a winner for somebody. I just think that there are better alternatives out there that I think will succeed rather than water intelligence. I don't disagree that leak detection will succeed. A product that can help with leak detection will help, but I know of at least 3 options out there: Arqiva, Ondo InsurTech, as well as water intelligence. So I know a thing or two about this market. Although I've never had well, no, I have had a water leak actually. So yeah, having one of those gadgets would have been very, very useful in my case. Anyway, moving on. Actually, let's talk about private equity. I've not written an article or not released an article on this, but I've been going through all the top 10 of the holdings in private equity and looking at their Q1 performances, and their Q1 performances are incredibly strong. So for this to be down 11.2%, this is sort of a 6 times holding. So 67 is 67. Divide that by 6 is the 11.2% performance year to date. Yeah, I mean, obviously, it's the whole thing about funds are moving out of America, and the US economy is going to go into some dreadful recession. It's interesting because a couple of things to say. The private equity is not just America. A lot of it is, but there's Triple I, there's EQT in Sweden, there's a couple of French, Swiss private equity holdings. So it's not just exclusively American. There's actually some of the American private equity are very heavily involved into Japan. So this is, I think, it's fair to say that the holdings will just chase after wherever the returns are and wherever the opportunities are. And I haven't kind of leaned into this one very heavily following the drop, but I've been kind of contemplating it, and I think certainly the Q1 results have kind of made me think, well, and I've been working on this over the last sort of day or so, so I've only just sort of started getting the results. So I mean, when the markets are back open on Tuesday, I wouldn't be surprised if I go and average down on this one. Actually, it's got a great track record, and these are smart people that are. And actually, the other thing to say is that whilst it's called private equity, it's only probably about 30% private equity. There's private credit. So in other words, they're lending money to businesses. Okay, so it's debt. It's private credit is just debt into businesses, and also real estate. There's a very large component of real estate and other assets as well. I mean, there's kind of a little bit of everything in these holdings. I mean, in the case of Triple I, they own a chain of shops that are sort of throughout continental Europe called Action, and I think that Action has delivered something like a 2,000% return or something. I might be wrong on the exact percentage there, but some dramatically large return over the years to Triple I. SEIT is down 14%, and this is one that I have been averaging down very heavily on. I mean, that is the same as the dividend. So the dividend yield is 14% as well. So I guess, on a 13.9% drop or loss, you'd make your money back in a year of dividends anyway. But I kind of think that the news about its Onyx sale is meant to be imminent. They said that that would be coming through before they announce their year-end results, and the year-end results are due in June, so it might even be in the coming week that we get some news on this one. Yeah, I mean, obviously, nothing is certain, so yes, it's possible that it's going to sort of announce some terrible news or something, but I don't know. Again, I'm struggling to see it because I suppose from my point of view, these are boring assets that just are sort of, selling into more or less captive audiences. That, I mean, yes, if the clients go bust, and actually as a good example, one of its holdings has got the Kodak, the Eastman Park, and it's a big industrial park where they're sort of delivering steam and delivering different services into different clients and tenants and so on. So yeah, like nothing is certain. And one of my readers actually contacted me and said, well, have you seen this news? Is this going to be really negative for SEIT? And it was the fact that one of the tenants had gone bust. Anyway, I looked into it and said, well, these are planning an expansion, but they actually sort of are not actively using energy in the first place because they are sort of under construction. Under construction means that, obviously they are sort of doing works but the thing is that SEIT is not the landlord of the property of the tenancy. So it's it's not like they've not been like they're not earning rent. Once they've got tenants that are settled in and live, with fully constructed buildings, then they earn income. So I suppose my response back on this was, well, look, the fact they've gone bust, they are a zero revenue to start with. They weren't using any energy, or certainly nothing significant, because they hadn't built their plant. So the fact they've gone bust before they could complete their plant, Glencore is sniffing around and have put in an offer to buy out the bankrupted business. So who knows? I mean, but I didn't see that as actually. Somebody else said, "Oh, well, I've got I think it's the US Solar Trust, and it's done terribly. So Onyx might do terribly as well." And again, I was thinking about this, and I thought, well, US Solar is like a utility solar company, and I don't know US Solar terribly well, but I did look at it for a time because of the fact it was on a very attractive discount, and I think that chap on Interactive Investor sometimes writes about it and bemoans the fact that he ever invested in them, and kind of, was whether the hard luck case was worth sort of looking at. Another person's misfortune is your opportunity sometimes. Anyway, I looked at it and I didn't like it, but I think they had debt and they had other things going on. I mean, Onyx, on the other hand, this is selling basically sort of, it's not utility energy, it's a business that has got energy requirements. It's kind of almost like SUPR, the supermarket uh, um, energy company, where like say Tesco's will have a superstore, they'll get SUPR or a company to come in and put solar panels across their roof. The company that comes in and puts them in pays for the solar panels, pays for all the capex, but then Tesco's buys the electricity. So once again, with Onyx, these are just captive audiences that have got long-term agreements to buy the energy. And if you've got solar panels on your roof and you've got an agreement to buy the energy that that's renewable energy that's on your roof, like, why would you do anything other than that? So could you then sell that asset where it's contractual income with clients? I'd like to think so. I mean, some of the clients as well. I mean, you've got the likes of the US Army is one of the, they've converted one of their camps, I think it is, like, all the Army accommodation blocks are all sort of renewable energy powered and this kind of thing. So yeah, I'm pretty positive about SEIT, but we'll see. Obviously, the proof will be in the results and also in the announcement for Onyx. But as long as that, as long as there's not some unforeseen great disaster, which I just don't think will happen. Because of the nature of it. If it was utility and if it was different, then I could understand the analogy or the read across from something like US solar. But because it's very different, and because it was growing very fast, and because the IRA, the Inflation Reduction Act, has not been repealed, and in fact, I was seeing today that the US Senate was striking down attempts to repeal certain legislation because they were saying, well, no, we don't want to lose that, and it's vested interests, that a lot of the Republican states have done very well out of the IRA. Texas is a great example, and they're not Democrat. They're true blue, true red, true red Republican. They're not true blue Democrat, that's for sure. Anyway, let's move on because time's where are we up to? Oh, blinking heck! I was meant to only do like 15 minutes. It's 50. Right, I'll go faster. Robotics again down 14%, and a lot of this, it was the flash crash and the whole thing with Nvidia. And others that just crashed on the. So will this kind of revert back up? I mean, I've edged back into it. And when it fell dramatically, and I think Nvidia fell to something like $90. I jumped on this and bought more because I thought, well, no, the long term trajectory of robotics is, and I just keep seeing more and more and more and more being spoken about robotics. In 2025, like in 2024, hardly saw it at all. Lots about AI, and I was sort of sat there thinking, well, yeah, AI, yeah. But AI is software, like a chat GPT is software on a screen. Well, like to have that software in the real world, you need robotics, because robotics is the arms and the legs and it's the movement that's kind of what you need to bring artificial intelligence into the real world. So yeah, I'm really positive about robotics and this robotics fund. I think, and it was interesting. I saw someone else write articles about, and they came down on RBTX being their preferred choice. But I thought their analysis was quite superficial, and they just sort of said, "Oh well, over a 3-year span and a 5-year span, da 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 da." So therefore, but robotics, RBTX is full of like AI software. Like if that's what you want, great. But go and buy an AI fund or an AI ETF. Don't call it robotics and then don't have any robots in there. Like where's the robots? And it was the same with unfortunately with Cathy Wood's ARK Invest, full of like just software companies and all these irrelevant, like Meta was in there. Well, Meta doesn't do robotics, has nothing, absolutely nothing to do with robotics. Anyway, rant over. I wrote about this one earlier today, so yeah, I mean it was up 20%, so that's minus 16 was minus 36 until yesterday. Yeah, I've been buying into energy fuels because I was convinced that that with government backing, that it's a one-way bet as far as and just again with all of the talk of nuclear and Japan powering back up its nuclear fleet, obviously Britain extending the life of its aging nuclear fleet, Germany reigniting its nuclear fleet, America has announced it's going to quadruple its nuclear fleet, China rapidly expanding its nuclear fleet, and SMRs, small modular reactors, they're very much in the news as well, and there's various different designs and different options. So yeah, energy fuels that makes uranium fuel, and it's the only American mill for producing uranium from uranium ore, again, it just feels like a one-way bet. And I've done a lot of research into the well, in fact, the reason I know about energy fuels in the first place was because I held Base Resources that had Toliara heavy mineral sands project, and the economics on Toliara are just absolutely I mean, if anybody knows Kenmar or any of these other heavy mineral sands, I mean, Toliara is absolutely first class. And then when you consider the monazite element of Toliara as well, it's got like 51.8 million tons of monazite that will generate vast amounts of uranium, but vast amounts of rare earths. And what does America need independence from China on? Rare earths. So absolute, Apax hasn't been doing very well, but I went in and looked at some of the holdings and actually quite liked it. I think it's quite overlooked and so on, but we'll see. EMV, that's been a disappointment for me. Not much news from it. I'm hoping just one day that there'll just be an RNS and everything will be forgiven. But it's been radio silence pretty much. Few pieces of news. There's they're holding in this. They've got quite a large holding in Northern Ireland, and they've done a financing round, so that could lead to something. But a lot of things that are just on radio silence, which where are we? Nearly sort of halfway through the year. It's not good enough really to have just radio silence. So disappointing. But as I say, suddenly the radio will crackle and all will be forgiven, and it will jump very suddenly. So it's certainly cheap. It's down 20% from when it was super cheap before. So we'll see. Pure Tech, they've actually had some really good news flow. I think it hasn't all been one way. So I think the schizophrenia drug is taking longer for Bristol Myers Squibb to ramp up. But the phase 2 work around IPF, which is idiopulmonary, I forget the F, but it's basically people with lung conditions. That looks very, very positive, and they've got multiple shots on goal. They've got quite a number of things going on. So I've been quite disappointed that it's just not, the market's not really getting it. But I remain of the view that it'll come good. And Cadence, again, just no news. Disappointing that there's no news, but and it's overdue for news, but I remain hopeful. I mean, it's one of these that if it comes through, if they actually get a mapper commissioned, or it's a sale, this will go from -28 to sort of hundreds of, well, potentially hundreds. Nothing's guaranteed, but again, it's at an extremely cheap valuation for what it is, which is a tier 1 iron ore producer. And iron ore's kind of bottomed out and is looking a lot, well, not a lot, looking a bit stronger now. So the market seems to be waking up to and Chinese demand is starting to come back as well. That obviously the sort of extreme negativity towards iron ore has been down to the extreme disruption from China with its housing market and that hasn't helped. So anyway, that's the Oak Bloke 25. I'm at an hour, so I'll leave it there. But I hope that's been useful and just sort of sharing my thinking on these 25 and look forward to new videos. As I said earlier in the video, none of this is advice. It's just me talking through my ideas. But thank you for joining me on this update, and speak to you again. Cheerio for now. Cheerio.